Some people put money into these private credit funds last year, expecting double-digit returns. This year, they found out they can't get it back for at least 12 months, and that's the funds that are being honest about the timeline. Here's what I keep hearing from people right now. They put money into one of these private credit funds. Their advisor told them it was sophisticated, institutional grade, the kind of thing that used to only be available to the ultra-rich. And the yield sounded incredible, double digits sometimes. So they said yes. And now they're reading headlines about gates closing and funds being locked, and they have no idea if they should be panicking or if this is completely normal. I'm going to tell you what's actually happening, not just the what, the why. And specifically, I'm going to tell you about one word that did a lot of heavy lifting in a lot of marketing brochures for a long time and is now being exposed for exactly what it always was. That word is semi-liquid. By the end of this, you'll know what that word actually means, why the way it was sold to regular investors was always going to end like this, and the 3 things you can do right now if you're in one of these funds. One of those things is going to make you a little angry. Not at the market, at the language. There are really 3 things happening simultaneously right now, and you need to understand all 3 to understand why this isn't just one bad fund having one bad quarter. Let's start with that word. Semi-liquid. It sounds reassuring, right? Not frozen solid, not totally free-flowing either. Like a middle ground, accessible when you need it. That is exactly what the marketing was designed to make you feel. Here's what it actually means. When you invest in one of these private credit funds, your money gets lent out to companies, mid-sized businesses, software companies, healthcare operations, service businesses that can't or don't want to borrow from a traditional bank. Those loans are not publicly traded. You can't sell them by pressing a button. They are, by design, locked up. That's in the documents. But what the documents say and what the brochure implies are very different things. The fund offers you a window every 3 months where you can ask to get some money out. It sounds like real flexibility. What it actually is, in reality, is a gate, a hard cap, usually 5% of the fund's total value per quarter. So if $1 billion is sitting in the fund, the most anyone can pull out in one quarter is $50 million, no matter how many people are asking. In good times, nobody hits the cap. Nobody even notices it. The gate is there, but it's like a do not enter sign on a road nobody's using. The problem is what happens when everybody wants to leave at the same time. This is not a hypothetical. This is happening right now in real time. One major fund recently had investors asking to pull out nearly 11% of the fund's total value in a single quarter. The fund honored less than half of those requests. The rest, denied. Come back next quarter, maybe the one after that. Industry experts say that when a fund gets this backed up, it can take well over a year to work through the line. A year. You put your money in, thinking you had flexible access every 3 months. You're now looking at a year plus to get out. And it's not one fund, it's not 2. The number of people trying to get their money back has hit record highs across the entire retail private credit space in the last 6 months. The rate at which borrowers are failing to pay back their loans has more than doubled from where it normally sits, and it's still climbing. Now here's what makes me actually angry about this. And I told you this part was coming. One senior industry figure said, and I want you to hear this, that he was shocked that people were shocked. Shocked that investors were surprised by any of this, because to him, the risk was always obvious. It was always in the documents. And technically, that's true. The gate was always in there. The lockup was always disclosed. What was not disclosed, what was actively obscured, was that semi-liquid was designed to attract investors who would behave like patient institutions, but who, when things got bumpy, would not. Because they're people, not pension funds. One industry observer put it plainly. The product was built for institutions with 20-year time horizons. It was sold to individuals with a, I might need this in a few years, mindset. That gap was not an accident. It was a feature. Because these retail funds are how asset managers raised hundreds of billions of dollars from regular investors. More money in, more fees earned. The gate was never a bug. It was always part of the design. Now let's talk about what's actually sitting inside these funds. Not all the loans are in the same situation, and knowing the difference matters. The first group is the solid borrowers. Real revenue, real cash flow, businesses that are genuinely performing. The problem is, these loans are not protected from what happens when a fund has to sell assets to raise cash for the people trying to get out. When a fire sale starts, good assets go out the door at discounted prices right alongside the bad ones. Not because they're bad, because the fund needs the cash fast. If you've ever watched a moving sale, the good stuff goes first, and it goes cheap. The second group is the struggling borrowers, companies where things were already going wrong before this started. About 25% of many of these private credit portfolios is tied to software companies. That was a great bet when AI wasn't eating their business models. It's a much harder bet today. Bloomberg reported that at least 250 software investments worth more than $9 billion had been quietly mislabeled in fund filings, listed as retailers, healthcare companies, food producers. Serious questions are now being asked about whether investors even knew how much of their money was sitting in software loans. These are the loans losing value, not just in dollars, in confidence. The third group is the one that should keep you up at night. Imagine you lend a friend $100, and every month, instead of paying you back $5, they say, "I'll just add it to what I owe you." So next month they owe $105, then $110. The debt grows. They're not officially failing to pay, technically, but they are never actually giving you real money back. That's what's happening inside a chunk of these portfolios right now. The companies aren't missing payments. They're just paying in more debt instead of actual cash. The industry calls this payment in kind. And the funds are counting that as income. On top of that, some loans are being quietly renegotiated behind the scenes. Terms changed, deadlines extended, problems papered over, so that the fund doesn't have to officially declare the loan a failure. Loans like this were running at nearly 3 times their normal levels by the end of last year. That trend has not reversed. Left alone, some of these companies would probably make it. Time and patience heal a lot in lending markets. The problem is, the wave of people trying to get their money back is now removing both of those things. We are halfway through, and here's what I haven't told you yet. What the fund managers actually knew before the gates went up. And more importantly, the moves some investors are already making to get out before the line gets longer. That's next, and it changes your options more than you'd expect. Here's how a manageable problem becomes a cascade. When too many investors try to leave at once, the fund has to sell loans to raise cash. Picture a garage sale where you're desperate to leave by noon. You'll take whatever someone offers. When you sell a loan for less than it's worth, that sale becomes the new reference price for every similar loan across the whole industry. Other funds look at that sale and say, "Our loans are probably worth less too." So they lower their own values. That spooks their investors. More people try to leave. More loans get sold cheap. More values get lowered. Each step triggers the next, and it doesn't need to be a catastrophe to start. It just needs enough people moving in the same direction at the same time. Here's what's happening behind the scenes that is making all of this worse. These private credit funds borrow money from big banks to make even more loans, using their existing loans as a kind of guarantee. Think of it like using your car as security to get a personal loan. The bank decides how much your car is worth, and that determines how much you can borrow against it. Now, the largest bank in America just said, "We think these loans are worth less than we did before." That means the funds can borrow less. In some cases, it means they have to hand over more assets just to keep their existing borrowing in place. That is not a small thing. That is the foundation shifting. And the safety valve that would normally exist in a situation like this, the Federal Reserve, which is basically America's central bank, cutting interest rates to make borrowing cheaper and give struggling companies more breathing room, that valve is jammed right now. Prices across the economy are still rising faster than the Fed is comfortable with, which means they can't lower rates without making that problem worse. So they're holding firm. The fund managers are stuck, the borrowers are stuck, and you, waiting to get your money back, are stuck behind that 5% quarterly cap with a line forming behind you. Remember that executive who was shocked that people were shocked? He wasn't surprised the gates were closing. He was surprised that the average retail investor didn't fully understand what they'd bought. He watched this get sold, and he watched it get bought, and he knew how the story ended. Which brings me to something I want to say directly. You didn't make a stupid decision. You made a decision based on information that was framed in the most favorable light possible. Semi-liquid, institutional grade, quarterly flexibility. Those words were chosen carefully to make locked-up paper sound accessible. Now that the market is translating those words into plain English, you have better information than you had before. What you do with it is what matters. 3 things. Let's go through them. First, figure out exactly what type of fund you're in. There are basically 3 versions of this. The first type, the most common one sold through financial advisors over the last 5 years, promises access to your money every 3 months, but only up to that 5% cap. These are the ones making headlines right now. The second type works similarly, same quarterly windows, same caps, same risks. The third type locks your money up from the beginning for a fixed number of years, and your timeline to get out doesn't shift based on how many other people are trying to leave at the same time. If you're in one of the first 2 types, you are in the structure that is currently under the most stress. If you're in the third, your situation is different, harder to exit from the start, but also not subject to the same panic dynamic. Step 1 is finding out which one you're actually in. Call your advisor today and ask that specific question. Second, check what your fund is actually invested in. Specifically ask how much of the portfolio is in software and tech company loans. Ask what percentage of borrowers are paying back in more debt instead of real cash, payment in kind. Ask what percentage of loans are currently failing to perform as expected. If your advisor can't answer those questions readily, that's information too. You should know what you own. Third, and this is the one most people aren't aware of yet, there are buyers, specialist investors, who will purchase your position in one of these funds right now, before the line moves. You don't have to wait 12 months. You sell to them directly, outside the fund's normal process. You won't get every dollar back. You might get 90 cents. You might get less. But if the alternative is sitting in a line for over a year while the loans inside your fund continue to deteriorate, taking a smaller amount now to get out clean might actually be the smarter move. This market handled $240 billion in transactions last year, up nearly 50% in a single year. The buyers are there. Most regular investors just don't know to ask. Here's the thing I want you to take away from all of this. The whole private credit market is not collapsing. Most of the money in it belongs to pension funds and endowments with 20-year time horizons. They're not panicking. They'll be fine. What is breaking is something more specific, a product that was designed for institutions but sold to people. That gap was always there. The market is just finally saying it out loud. You're not stuck because you were naive. You're stuck because the word semi-liquid was doing a job it was never going to be able to keep doing forever. Now you know what it actually means. And knowing that is where your next move starts. Know your structure, know your exposure, know your exit options. Don't wait for your advisor to volunteer this conversation. It's already overdue. If this is the kind of clarity you want before the headlines catch up, subscribe. That's what we do here. One question before you go. Did your financial advisor ever explain what happens if too many people try to get out of your fund at the same time? I'm genuinely curious how many of you had that conversation before you put your money in.